Welcome again, friends, to Etienne's Place, the place where we continue to keep it simple and to the point. I thank you for your many feedback, and of course, I encourage you all to subscribe to Etienne's Place so that you will be kept informed and up to date with all our upcoming goodies. Now, you will hear going forward in this year, you will hear the phrase financial common sense being mentioned over and over and over. And this is intentional because whether or not you recognize it, most seemingly complex financial and economic concepts can be broken down into what I refer to as simple bread and butter analogy. And so at Etienne's Place, that's our purpose, to take these complex issues and to reduce them to what is a simple, easy to understand setting. And so again, I encourage you to subscribe to our channel so that you can access all our past videos and you will definitely be in line to be alerted when we have new publications, new videos coming forward. Now, I mentioned financial common sense. I am by no means indicating that it is the intention of the powers that be to make things so complex that the common everyday person, so to speak, would not be able to understand. It is my view, however, that a lot of the things that we grapple with, a lot of the mistakes that we make, a lot of our shortcomings in thinking through our finances, etc., are based on the fact that simple, basic understanding is not made available. And if that was the case, if it was made available, we would be far advanced in our financial planning, in structuring our financial lives. And so once again, at Etienne's Place, we're taking the seemingly complex and we're reducing it to very, very basic, direct, and to the point. Today, I want to look quickly at two items. And yes, it is a tax season, and so most persons will have an interest in hearing, hey, how can I go about maximizing my returns? How can I go about ensuring that I do the right on my taxes? The first thing that I'll speak to is selling your home. Selling your home. During the tax year, you may find that okay, for one reason or the next, it was necessary for you to sell your home. And so you sold your home, you get your documentation, and you take it to your tax preparer so that they can include it on your tax returns. And let's use some hypothetical figures. Your home had a market value of, say, $100,000, market value, book value, just trying to keep it very simple. You sold it for $120,000, and so the numbers indicate that you have made a $20,000 capital gain, because your home is really like a capital expenditure, capital gain. And right off the bat, it would seem that hey, you're going to have to contend with some taxes on this $20,000. However, there are several things that we need to bear in mind. The first thing, and the first good news, is that you are allowed what is referred to as an exclusion. And the exclusion is on the first $250,000 $250,000 gain. Gain. 200 on the first $250,000 gain that you make on the sale of the house of the home. You are allowed to exempt that from income, from your taxable income. And if you're a married couple, that doubles. Married couple, then you both are entitled to a $500,000 exemption. But as a single person filing singly, then we're saying that you can exclude from income that. And most homes sold would not necessarily be showing a profit of 250,000. So in most instances, persons would qualify for this, what I call this exclusion. Now, everything has to have a little twist to it, huh? So we need to first determine the qualifying factors, for this exclusion. Factor number one, which should be very obvious, you must own the home. Yes, you cannot go and sell somebody else's house, make a profit, and then trying to do some exclusion, tax purpose exclusion. No. So you must first own the home. Now, the ownership here for this purpose follows a very strict line. You must own the home for at least 2 years out of the last 5 years leading up to the sale of the home. Okay, so if you're selling your home this year, then go back 5 years, and then we're saying you must have owned this home for at least 24 months, 2 years out of the past 5 years leading up to the sale of the home. So that is number one criteria for qualifying for this exemption or this exclusion from having that profit, that gain be included in your taxable income. That's number one. Now, residency is number two. Residency. This must have been your primary dwelling place. This must have been your home. Some of us, fortunate enough, not us, some of them, fortunate enough, have multiple homes. And so we're saying the one that you're selling, on which you're seeking the exclusion, must be the one that served as your primary residence. Again, it must be your primary residence for at least 2 years out of the previous 5 years. Now, there's a very important aspect to this. Let's go back to the ownership. Qualifying under the ownership provision, if you're married, if it's joint, then we're saying that only one partner, only one person need to qualify, meaning husband and wife lives in this home. This is the family home. It only requires for the husband or the wife to have owned this home for at least 2 years of the previous 5 years to qualify for the exclusion based on the ownership criteria. However, for the residency criteria, it is different. Both the husband and the wife must have lived in this home for at least 2 years of the prior 5 years leading up to the sale of the home. Very, very, very important. Okay? Then we go to the third qualifying criteria. And this is what we call the look back period. It's a colloquial, sort of term, but look back period. What it is saying is this. Looking back, you must not have sold another home in in the past 2-year period before the date of the current sale. Mean that you can, you see, once you start to buy and sell home ongoing, then hey, you're now more into some sort of rental property commercial activity type thing. So we're saying for you to qualify, you need to look back, and you must not have sold a home in the prior 2 years leading up to the sale. Okay? Or if you if you sold a home back then, you must not have claimed the exclusion. So it is really a case that of saying that the exclusion cannot be something that you get the benefit of, for year after, home sale after home sale after home sale. Okay, so quickly running through the three criteria to qualify you for the exclusion. One, ownership. Ownership. So you need to have owned the home at least 2 years in the prior 5 years leading up to sale. Again, we're saying that the ownership only needs to be ownership by a husband, ownership by a wife, not necessarily both if it's a joint situation. We go to this number 2, residency. Again, you must have lived in this home as your primary residence for the past 2 years out of the past 5 years. Unlike the ownership requirement, however, it is saying that both spouses, both husband and wife, must have lived in the home to qualify under the residency criteria. And the third is a look back period, where we're saying you must not have sold another home 2 years prior, or if you did, you must not have claimed the exclusion, because if you did then, you cannot now. Okay? Tidbits on home sale and making a profit and the implications for your taxable income or your tax returns. Just a little tidbits. Again, as usual, when we present these things, we break them down to their simplest common denominator, so to speak. So there may be other aspects or the technicalities to it that once you speak with your your professional provider, your tax providers, your tax advisors, whatever, they will take you through the specifics of your situation. But here, what we're trying to do is to give you the basic, because remember, I said earlier on, we are focusing on financial common sense, giving you the basics so that you understand it. If you want to go a level or two above financial common sense, it would sound to me that you want to move into the realm of financial not so common sense. But we're keeping it real, financially, commonly, sensibly, right here and right now. Okay? Fine. That was selling your home. I want to look at next at the child tax credit. The child tax credit. On a previous earlier video, I mentioned, among other things, I was speaking to the different tax changes for 2018. One of the things that I mentioned was the child tax credit, and I want to spend a little more time on it today. The child tax credit is one such credit that most taxpayers benefit from. And we have children, and remember the criteria now. For you to receive the child tax credit, there are several qualifying criteria. But before I go to look at these, I just want to, again, I'm always giving word of caution, word of warning. That's just my thing. I want us to be on the straight and narrow, okay? Child tax credit, very good credit, very dangerous credit due to the way it has been abused by persons, by individuals, okay? More so now that for 2018, the child tax credit has moved from $1,000 per child to $2,000 per child. And so it is more attractive. The incentive to do less than what is right is more appealing. And so, me a beg you, I'm appealing to you. Be cautious. Do the right thing. Okay, the child tax credit has moved from $1,000 to $2,000. And I just remind you, because what you find is that quite often taxpayers will satisfy most of the requirements to claim a child tax credit, but maybe one or two may not fall, in their reality. And you have to be very careful because you will know as much as I do that the IRS is being very, very, very vigilant. As a matter of fact, when it comes to the earned income credit and the child tax credit, those two credits, those are the two things that more often than not, the IRS will want to delay releasing refund, to make a double check, to confirm, to verify, to ensure that, because the statistics have shown that large sums have been paid out and paid out, paid out to taxpayers where some of these claims made were less than true, less than accurate. Okay, so first thing first is that it continues to be that the child, the dependent, ought to be less than 17 years old. Child under 17, right? To qualify for the child tax credit, you have a dependent child that is under 17 years old. That child, that dependent, must be related to you. Your son, your daughter, your grandson, your niece, your nephew. That child, that dependent must be related to you. And if there's a case of, an adoption, if this is an adoption, an adopted child, then of course you need to have the proper adoption paper documentation that must be in place. Okay? The child or the dependent must live with you, the taxpayer, for more than half of the year in question. The child must live with you for more than half of the year in question. And the next criteria, qualifying criteria, is that this dependent, this child, must not have provided more than half of what you call its own support. Okay, so this child must not have been in a position to be basically independent of you. So the child must not have provided for more than half of its support during that year. So there you have it. Those are the qualifying criteria. So be very careful, be very wary, be very vigilant. And this goes to my fellow tax preparers, and this also goes, of course, to you, the taxpayer. Okay, so again, this is it for now. We'll be coming back week after week with these financial tidbits to empower you, to inform you. And remember, if you want to ensure that you miss nothing, but you're empowered through these videos, then ensure to subscribe so that all future presentations will come to your notification. We thank you again for joining us at Etienne's Place, the place where troubles, problems do not abide. The challenges will creep in from time to time, but we have the answer. This is where we find the solution for all those challenges. So keep strong, keep working hard, keep faithful to the task, and ensure to be financially aware, financially in tune. Ensure that you have financial common sense. Nothing complex, just a basic understanding that will help you to make the right decisions. So for now, Etienne Space signing out. Have a good week. God bless.